I see names coming in. That's always a good sign when the technology works. Always makes me smile.
Yes, that is true. We can hear each other, we can see each other, and people are joining, so it's perfect. All right, I guess we can get started now. Thank you everyone for joining us for our webinar on winning stocks and how to find, buy, and own them. My name is Michael Chu. I am the head of investments at Sarwa, and I'm really excited to be joined with Brian Feroldi. Brian, why don't you just take a couple minutes and let our viewers know why your background and what we're going to be talking about today.
Sure thing. Hey, everybody. My name is Brian Feroldi. I've been investing in the stock market for more than 20 years now as an individual investor. When I first started back in 2004, it was right after I graduated from college. I had no idea what the market was or how it worked. I thought the stock market was essentially a giant gambling machine that you tried to buy a stock for $1 and sell it for $1.25 later that day. So I started out with day trading, and thankfully that went horribly for me, and I lost hundreds of dollars at the time, which felt awful and was a lot of money. But I stuck with it, and I've become a passionate believer that the stock market is the greatest wealth creation machine of all time. For the last 10 years, I've been working for the Motley Fool, writing articles for them, doing podcasts and videos and stuff for them. And about 5 years ago, I started a company called Long-Term Mindset, and we teach individual investors how to analyze businesses so that they can manage their own portfolio with confidence.
Perfect. Thank you so much, Brian. Before we get started, we have a couple of disclaimers to go through. We can't tell the future or have a crystal ball. I can tell you what's going to happen in the next few months or years, so no one does. Our views are not as one-on-one advice. Do your own due diligence before making any decision that may impact your financial well-being. All investment is subject to risk. All right, Brian, we're off to you.
Great. Well, thank you, everybody, and thank you for joining us today. As Michael teed up, this is a presentation that's all about finding winning stocks. I've been investing my portfolio for more than 20 years now, and over the last 15 years, my personal portfolio has walloped the S&P 500. I'm up over 275% over the returns of the market over that time, and I've done so. The only reason I've been able to outperform the market is because I've developed a system for identifying winning stocks. So let's start by just defining, well, what the heck does that mean? To me, a winning stock is a multi-bagger stock. A multi-bagger is just a stock that returns a multiple of itself. So if you've ever read the book One Up on Wall Street by Peter Lynch, he kind of coined the term multi-bagger or winning stock, and that just means how many times the stock returns its value at the time of purchase. So a 2-bagger is a stock that doubles. A 10-bagger is a stock that goes up 10x. A 100-bagger, which do exist, is a stock that returns 100 times your initial investment. So I've been lucky enough to get many of these multi-baggers into my portfolio. Some of my biggest winners of all time are likely companies that you have heard of and are familiar with. Netflix, Tesla, Intuitive Surgical, Mercado Libre, MasterCard. These are many stocks that I've held for more than a decade, and they have just they have been the engine that has powered my personal portfolio's return higher over time. And getting these winning stocks into your portfolio is absolutely essential if your goal is to outperform the market. They literally drive all the returns. And that's not just me saying that because it's a gut feel. I love this visual here. This is a visual that was made by JP Morgan and FactSet. And what they did was they studied the 3,000 individual stocks in the Russell 3000 over a 30-plus year period. And what they did was they mapped the return of each individual stock compared to the index as a whole. And what they found was that the median stock or the average stock, the 50th percentile stock, underperforms the index. The average stock out there underperforms the market's return. So the majority of stocks out there will underperform the market. However, about 7% of stocks, 7% are multi-baggers. And those multi-baggers account for the vast majority of the total returns of the index itself. So if you're going to be buying individual stocks or looking for individual stocks, I think that this information is absolutely crucial to have in the back of your head, where if you buy 10 stocks, 10 well-researched stocks, you should expect that 5 of them will be bad performers. About 3 of them will be average performers. They'll match the index. And then 1 of them will be a mega winner that literally drives more returns than the other 9 stocks that you've bought combined. Many people that are investing don't have that mental model in their head. So they think they're doing a poor job if they get those kind of results. What they're missing is that those are the results that you should actually expect and that you should be aiming. The only thing that matters with investing in individual stocks is getting those few big winners into your portfolio, because they drive everything. Now, when it comes to identifying those huge potential winners, I point to this fantastic book by an investor named Christopher Meyer. So he did a multi-decade study of all of the stocks in the stock market that were 100 baggers. So they returned 100x the investor's initial investment. So if you invested $1,000 into these companies, they returned $100,000 to you. And he identified a couple of characteristics that these 100 baggers all had in common. Characteristic number 1 was they were small. These were not huge companies to start with. They were all under $10 billion in market capitalization at the time. In fact, many of them were well under $1 billion in market capitalization. And if you're unfamiliar with how big that is, a $1 billion company is actually considered a small cap nowadays. So $1 billion, a lot of money in like real dollars in absolute terms. In investing terms, that's a very small business. The second trait that he identified was that these were quality enterprises. Now, quality is certainly a subjective term. What does that mean? Quality means different things to other people. But quality to Christopher Meyer essentially mean these were businesses that had a competitive advantage. They had good economics working for them. So the product or service that they sold was beloved by their customers. They were in markets that were growing or at least stable, and they were run by good managers. So they were just quality businesses. The third characteristic was that they were growth companies. Many of the companies that were returned the highest percentage also had enormous sales growth behind them. They were able to grow their revenue and profits at a 20% annualized rate for 2 decades or even more. So if you're going to be looking for companies that have huge upside potential, they need to have huge growth potential built into them. The fourth characteristic was that they were durable in nature. Durable in nature. It's one thing to be able to grow to take advantage of a hot trend that you see, like a clothing company that suddenly becomes fashionable, or an energy drink that has a huge TikTok following and takes off for a short period of time. But durability was an absolutely essential trait to these companies performing well. So durability means that the business itself was defensible in some way. It had a moat associated with it, whether that was network effects or switching costs or had a high quality brand. Growth, for growth with short term that eventually peters out isn't valuable, isn't valued by the stock market. Durable growth is. And then the fifth and final trait of these winning stocks was that they were trading at very reasonable valuations to begin with. They were not extremely overpriced when they went on their historic run. Many of these companies were trading in value territory, and then when the market saw that they were growing and that they were durable and that they were quality, they actually became more highly valued as they grew. So these to me are the key traits, the 5 key traits: small, quality growth, durable, and a recent valuation. This is the hunting ground that we should aim for if we're going to be trying to find these multi-bagger stocks. So Michael, I just threw a bunch of information at you. Are there any questions that we have so far?
Right now, we do have some, but I think this is going to come up in a later conversation um, when we progress further on.
Okay.
Um, these are great. A lot of information. I mean, as we progress, we're going to talk about screening them. But out of these 5, which one do you think is the absolute most important and least important, or do you weight them all the same?
Yeah, if you forced me to rank them, um, I would probably put quality first. A
Okay.
company that has good economics, good management. It's just a solid, profitable business. That to me is criteria number 1. Number 2 would be durable. Um,
Mm-hmm.
Durable needs if you buy a quality business that's durable in nature, even if you get the other 3 wrong, you probably won't get hurt by investing in that. So I would go quality first, durable second. Growth, I would do third, because what we've seen over the last decade or so is that even companies that are big in size can still have very strong growth. I mean,
Mm-hmm.
let's take Apple. When Apple was a $300 billion company, which is absolutely massive, gargantuan in size, it still produced 10x returns from there. The same is true of Nvidia. The same is true of Microsoft. When these companies were already absolutely gargantuan, they were still all able to put up really strong growth.
Mm.
So I would put that one third. Fourth, I would do valuation because the starting price you pay does impact your future returns. And the fifth one, I would say that the least important is small, just because of what I just said about what we've seen about these huge mega caps. But all things held equal, it's a heck of a lot easier to find a 100-bagger in a company that's worth $500 million than it is to find one that's worth $500 billion.
True, very true. That being said, were you buying some of the mega cap names that exhibited growth of 10x?
Yep, absolutely. So I
Yep.
first invested in Amazon after it was, I think, a $30 billion company, which is, again, a
Hmm.
pretty decent sized company. And now that's a $2 trillion company. So tremendous returns even after I'd been a customer for years, and even after I was fully aware of all the benefits, and even after Jeff Bezos was like a household name. It's kind of amazing that you can buy these companies that everybody knows and everybody is aware of, but if you hold them for a long period of time, they can still deliver really good returns for you.
Oh, perfect. We do have one user asking, how do you identify the valuation in reasonable stock? Maybe some
Uh,
tool.
Great. So valuation is a very tricky thing to figure out, because first off, let's talk about how you should value a company. The way that you should measure a company's value changes depending on what phase of the business growth cycle a company is in. Let me give you an example. Take a
Mm.
company like PepsiCo or Coca-Cola. These are large, established companies that have been profitable for decades. They pay dividends out. You can, when looking at these companies, you can use many of the classic, most well-known valuation tools. You can use the price to earnings ratio. You can use the dividend yield. You can even do a discounted cash flow analysis on these companies because the numbers are there, they're solid, and you have a long history to look at. And they're generally reasonably priced by the market. You cannot do that same analysis on a company that is just breaking even. For example, I would argue that the price to earnings ratio for a company like Tesla is utterly useless. Tesla has is reinvesting so heavily in itself, and it has so many growth areas built in that's futures are currently unknown. That if you make an investing decision in Tesla based on the price to earnings ratio, you're gonna get the wrong answer. So valuation is as an entire presentation in itself. But a key thing that I've learned about valuation is you have to use the correct valuation method at the correct time in a company's history. And if you use the wrong method, the right method at the wrong time, you're going to get the wrong answer.
Right. We had Tamoy just message in, if you have 1 to 4, one of the 4 besides valuation are all in your favor, wouldn't that just drive up valuation? Would give you a valuation figure that is maybe overvalued in your view?
Yes.
How do you overcome that?
Like anything, you are correct. If you find a small quality growth company that the market thinks is durable in nature, it's very rare to find it at a very attractive valuation. So if you have 4 of the 5, what should be the time when you're like, okay, I'm still going to do it? If it depends on the degree of valuation. Again, I'm just going to use price to earnings ratio because that's what everybody knows. Let's pretend that a company had all of those characteristics, was profitable, and the profits were real. So in that scenario, the price to earnings ratio worked. It was a real number that you could look at. And you saw that that company was trading at 100 times earnings, which is a very high valuation number to look at. Paying 100 times earnings for a stock can be okay if the company's growth rate is high enough to justify it. So if you believe that that company can grow at a 30% clip for the next 5 years, paying 100 times earnings, you'll probably still do fine because the growth rate is high enough. But if that company is only growing at 10% per year, if you pay 100 times earnings, you are not going to do well as an investor, even if the company achieves your growth targets. So, quote unquote, overpaying for a stock is okay so long as the growth rate is high enough to justify the overpayment. But that is a art in itself, and it also depends on the mood of the market. It depends on the interest rate. So there's way more factors than you need to think to. But as a general statement, the higher the growth, the lower, the more accepting of a high valuation you should be, and the lower the growth, the more you should focus on valuation.
Perfect. Thank you for answering those. Great. If it's okay with you, we can move on. Thank
Sure,
you.
absolutely. Okay. So, all right. So we've identified what the heck a winning stock is, what are the characteristics of it, and why it's so important to get them in your portfolio. So I'm going to talk through the process that I use to find these stocks, to screen them for quality, and to put them into my portfolio. So step 1 is just finding these stocks. How do you go about finding stocks? It has never been easier in history to find stocks. There are so many wonderful tools out there to do so. So looking beyond AI, which you could probably use now to even do some of this, I'm going to show you a couple of easy methods to do so. First, I love to crack open exchange traded funds, ETFs. You can go to Yahoo Finance or Google Finance or plenty of places online, and you can find exchange traded funds that meet a theme that you're looking for. For example, if you're looking for momentum stocks, there's an ETF that tracks momentum stocks. If you're looking for cybersecurity stocks or AI stocks, or biotech stocks, or pick a growth avenue that that you can think of. All you have to do is take that ETF and then look at the holdings in it. And while you might not buy the whole basket of ETFs in general, ETFs are a great way to find stock ideas that meet some kind of theme that you are going for. So on the screen here, I just put up 8 sample ETFs. These are largely growth ETFs that are out there. The FFTY is an Investors Business Daily ETF that tracks like the 50 top holdings in Investors Business Daily. And that ETF has actually done pretty poorly as an ETF, but I still think it's a great place to get ideas for quality companies that are growing fast. The same would be true of TMFC, that's the Motley Fool's ETF. And again, it's a great place to get ideas for stocks that are growing fast. So you simply take the ETF if you've never done this. Oops. Crack it open, and here is a look at the FFTY on that momentum/growth one that I talked about. And as of April 29th, here were the top holdings in it. So here are the tickers, here are the companies, here's what segment they were in, and the portfolio weighting in the ETF. And just look at these. These are pretty much guaranteed to be high growth companies that in many cases are also profitable in nature. So this right here would be plenty of stock ideas for you to start researching. So place number 1 is exchange traded funds. Place number 2 is to copy super investors. So again, it's never been easier for us to track what big professional investors are doing with their capital. There's guaranteed to be, no matter your investing style, an investor out there that is trying to achieve whatever you are achieving, and it's easy and free to track what stocks they are buying and they are holding. As an example, I consider myself to be a quality growth investor. I'm after high quality stocks that are also in growth mode. Well, Pat Dorsey of Dorsey Asset Management and Terry Smith of Fundsmith are also quality growth investors, and they're managing a couple of $1 billion in capital. So there are tools out there that you can use. This is from a website called FinChat, where every 90 days, Pat Dorsey has to publicly disclose his portfolio and all the stocks that are in his portfolio. So going through here, here's a list of stocks that Pat Dorsey thought were quality, durable growth companies. And here is the capital that he has allocated to them. And using tools like FinChat, or Dataroma, you can track how their portfolio is changing from quarter to quarter. Now, again, I would never blindly buy just because these investors bought. But the goal here is coming up with a watch list or just finding stocks to research. And if these stocks made it through Pat Dorsey's criteria and are in his portfolio, the odds are pretty good that they're also going to make it through my criteria. So find super investors that match your investing style and track what they're holding. It's free. Finally, there are paid services out there. I have personally had success with Motley Fool Stock Advisor and Motley Fool Rule Breakers, where you pay them a couple $100 a year and they give you vetted stock recommendations, and all the research is done for you, and they track the results and everything. Other paid services, there's lots of them out there, but Investors Business Daily, Morningstar has some. These you do have to pay for, but you typically get higher quality research, and they give you the ideas and the research and everything. So this can be another place to just build a watch list of ideas. So there's 3 ideas for you, and just those 3 ideas will give you far more stock ideas than you could possibly research.
Perfect.
Yeah. So, okay. So we have our watch list. We have a list of stocks we want to use. Well, the next step is to screen that list for quality, or screen that list for the metrics that matter to you as an investor. Now, there are lots of ways that you could do this, but here's what I recommend everybody do. First, write down a list of all of the traits that, if a company had these traits, you would find it to be attractive. For example, here are some of the things that are on my list of attractive traits of a company. I love it when I find companies that are free cash flow positive, that the insiders of the business own a lot of the stock. I love it when the company is growing organically, not through acquisitions, but through their own products. I love it when they have pricing power so that they can raise prices. I love it when they have a great balance sheet and their products that they sell are recession proof and recurring in nature. So here is an abbreviated version of my list of, if a company has these traits, positive. That's list one. List two, what are the traits that if you saw these, you would be turned off by that investment? It's a bad time, bad investment. So for me, that's things like I don't like it when a company's financial statements are extremely complicated. Like, if my head hurts trying to track the balance sheet and the income statement, if it's laid out poorly, or it has a complicated, it's very complicated, that turns me off. I don't like it when a company has a lot of its revenue tied to a single customer, like Walmart or the U.S. government, or some one big customer makes up a lot of the company's revenue. That's very risky to me. I
Yep.
don't like that. I don't like it when there's geopolitical risk that's going on. Perhaps it operates in a part of the world that is geopolitically risky. I don't like it when there's antitrust concerns, so the government has set its sights on this business. Or I don't like it when the balance sheet is packed full of debt and it has just a little bit of cash. So again, make a list. Here are some of the things on my list, but what attributes, if a company had them, would turn you off? So now we have these two lists, one good, one bad. Now comes the good part. Force yourself to rank them. Most important to least important. This exercise will teach you a ton about what you're actually looking for in a business as an investor. And you force yourself to put them in order from most important to least important, because doing so will reveal what the traits you really want to find in a company. So I've done this process, and then I have my traits, right? And I categorized them into 7 basic categories. So company's financial statements, the moat, the long-term growth potential, the relationship with the customers, the quality of the revenue, the management team, and the performance of the stock. Then what I did was I forced myself to allocate 100 total points to those attributes. And this is why forcing yourself to rank them from most important to least important is so useful, because you have 100 points to allocate to each of those key decisions. Again, this is forcing yourself, your process, to really hone in on the metrics that you truly value as an investor. So here is how those 100 points came out to me when I did this process. So I found that the moat, the company's defensibility, was the most important trait. I thought that the growth potential was the second most important trait. The financial statements were the third most important. The management team were the fourth. Fifth was the performance of the company's stock. And then 6 and 7 were the customers and the revenue quality. So here is how I allocated these points after giving it a lot of thought. Then, so that's the good things, right? This is the good investment. I did the exact same thing for my bad traits. So I ranked them from most important to least important, and I allocated negative points based on what I saw there. So, for example, if a company has accounting irregularities, meaning, oh, we can't trust the numbers we've been sending out, that to me is basically you're dead to me forever. I thought that was the worst thing a company can do. Because if I can't trust the numbers that you've presented to me with to make decisions, why would I bother with your stock?
Yep.
For me was customer concentration. I do not like customer concentration. So you can read the rest if you'd like, but again, forcing myself to say what's the trade I'm trying to avoid, the second trade I'm trying to avoid, and so now I have a system in place, and I have this checklist that I've built, and it's weighed according to the criteria that I am most interested in, and it subtracts the criteria that I'm least interested in. Then I take the stocks that were on my watch list, I run them through my criteria, and then I come up with a list that represents what are the businesses that are the best match for what I'm looking for as an investor, and what companies are only meet some of the criteria that I'm looking for. So that is how I go about screening them for quality. It's not screening them for quality that like academics say is the best. It's screening them for the quality that I, as an investor, have identified as what matters to me. So this is why I recommend if you're watching this, you go through this process yourself, because what might matter to you as an investor is different than what matters to me as an investor. And the stocks that come out this process the other side, I have identified are the best fit for my investing personality. Okay.
All right.
So we found
So
them. We've got the what? Yeah, I'll say let's pause, I guess, for questions there.
pause. Yes. I mean, there's a very thorough process. On average, how long does it take for you to run a stock or company through that process? And how many companies do you have on your watch list?
Yep. So when I first started to do this, by the way, the process I just described to you, this is like version 4 of this process. I've actually refined it by talking through it with other investors, which is just so helpful because
Okay.
anyway, I learned that building constraints into it, like the 100-point things, was absolutely critical. Otherwise, it's easy to just dilute your checklist into oblivion. If you gave me a company that I'd never researched before, had never heard of, I could probably go through that entire process in about an hour.
Wow.
But I've also been doing this hundreds of times. If you were doing this from scratch and you'd never done this before, it would probably take you a few hours to do so.
I
But
would probably say half a day.
yeah,
First go around.
it totally depends on what your current level of investing knowledge is, right? So I've been researching companies for 20 years. So I know where to go and how to click and to find all this information. And Michael, we were talking about this before. I'm very confident that you can use AI to shortcut a whole bunch of this and get probably 80% of the way there a lot faster.
I was just going to ask that, and I think we were talking about that. 80% sounds pretty good. I
Yeah.
mean, taking the average investor maybe half a day to do it by hand, we're cutting down to 80%, and then doing that last 20% to do final checks and sanity checks. That's more palatable than trying to go through your process. Thank God for AI tools.
Yeah, AI is going to make this a heck of a lot easier. I don't
Thank
see any
you.
other questions, so I guess I just keep going.
Yes.
Okay. All right. So now we're going. Okay. So I've got a list of stocks, right? That's thing 1. Step 2, I've screened them for quality. So now I have a list of quality stocks that meet the criteria that I'm looking for. The final step is to add the stocks to my portfolio that are my favorites from that group. So when I'm trying to think about, well, what stocks are my favorites, I think of a multiplication of three things at any given time. I say, what are the highest quality stocks that have made it through my list? That's thing one. And then of those stocks, which ones have the highest growth potential, right? The most upside potential from here. And then of those, what is the best valuation company? So I'm looking for what's the highest quality companies with the highest growth potential trading at the best valuation right now. And those are the stocks that I target my capital that I'm going to be investing for. Now, we touched upon this a little bit before, but boy, that word valuation is loaded because valuation means different things to different people. So let's double click on that word for a second. When it comes to valuation, what I've discovered after studying the great investors for a couple of decades is that the way that people think about valuation is really across a spectrum. On one side of the spectrum, on the extreme left side of the spectrum, are venture capitalists like Mark Andreessen, okay? Venture capitalists don't care about valuation at all. The only thing they care about is the future potential of a company, right? The only thing they care about is this the next Facebook? Is this the next Airbnb? Is this the next Uber? If they think it is, they're investing. Valuation is concern. It's not even on their radar as a concern. They just want their money in the business. On the other end of the spectrum are people like Michael Burry or Benjamin Graham. And these investors are value investors. And to them, valuation is everything. It's everything. They will buy any business as long as that business is cheap enough. So in between those two extremes, you have something called GARP, G-A-R-P, growth at a reasonable price. And how much of an emphasis you place on valuation completely depends on where on this spectrum you sit. Now, to give you some ideas, here are some famous investors that many people have heard of. People like Mark Andreessen and David Gardner, Cathie Wood. These are growth investors. They do not emphasize valuation. They emphasize upside potential. They're going after 100 baggers. They're stepping up to the plate and they're trying to hit grand slams. And if they strike out, they're okay with that. On the other end are people like Warren Buffett, Benjamin Graham, Michael Burry, Manish Pabrai, Charlie Munger. They're very focused on valuation, and that is a major criteria for them. And then in the middle, you have Terry Smith and Chuck Aker, Peter Lynch, Charlie Munger. These are investors that are okay with paying up for a stock, but it better be a high quality company. So when you ask somebody, well, what's this company worth, or what's valuation should I use? The first thing you need to ask is, well, where on the spectrum are you investing? Where on the spectrum is your mindset? Because if you're thinking if you naturally think like a value investor, and I tell you, well, I like this growth stock, of course you're going to reject it. It doesn't meet the spectrum. It doesn't meet the part of the curve that you're investing on. So this is why understanding the spectrum is so important. Now, for me, I naturally started it out as a value investor. That's core to my DNA. I like to go to the grocery store and buy things on sale, right? I want to get a good deal.
Yep.
Yeah. So that is the natural approach that I bought to investing. And when I did that, initially, the first filter that I would put stocks through was valuation. And the only stocks that made it into my portfolio were those that fit this very tight valuation filter. So a lot of when I had this mindset, you have to rewind the clock to 2006. This should say 2006, 20 years ago.
Okay.
I came across Salesforce.com as an investment. The company I was working for at the time hired them as a company. We brought them into the company, and our company ran on Salesforce. And I remember being like, this technology is incredible. We can do all of our customer mapping on this. If Salesforce shut down, our business would come to a grinding halt. So I looked it up. Is this a publicly traded company? Yes, it was. And here's what I saw back in 2006. It was a $3.4 billion company, so relatively small, but it was trading at 10 times sales, and its price to earnings ratio was 160. Okay? So what did I see as a value investor? Nope. Stop. I am not buying this stock. Way too expensive. Way too expensive. So I would say, if you're familiar with the margin of safety concept, there's no margin of safety here. It's trading at 160 times earnings, right? I am not going to be buying this stock. So it got caught in my valuation filter. It did not enter my portfolio. Well, if you know anything about Salesforce.com, this stock, I missed out on a 60x return in Salesforce.com, a 60x return on a company that I knew well was small and I thought just had fantastic technology. And I missed out on it because it was quote unquote too expensive. I was putting valuation first over business quality. That was the mindset that I had. And I was doing that when I started to study the great investors like Charlie Munger and Warren Buffett. Buffett has this fantastic quote, and he just says, it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. So, So I slowly over time, after seeing companies like Salesforce and Amazon and MasterCard, these highly priced companies that outperformed, my investing mindset, my valuation mindset started to shift to the left. I taught myself to think more like a venture capitalist and less like a value investor. I taught myself that business quality, the quality of the business, is more important than the valuation that I paid. So my new filter looks like this. I have a very tight filter for business quality, but if you're a quality company, I have a very wide filter for valuation. I would rather get a quality company that's overexpensive in my portfolio than a low quality company that's cheap. And only in the last couple of years have I realized that studies actually show that's the proper way to do things. This is a study that was done by BCG Analysis and Morgan Stanley. And what they looked at was what drives stock market returns over various periods of time. What is the thing that causes a stock price to change? Well, over a 1-year period, if you look here, the most important thing, 46% of the stock market's return are driven by the multiple, AKA the valuation. In the short term, which I consider 1 year to be a short term, the valuation is going to determine how well you do as an investor. It's the number one thing. But notice as the time frame increases, the valuation becomes way less important. And the thing that becomes far more important is sales and profit growth. So over the short term, valuation is king. Over the long term, it's sales and profit growth that is king. And when I learned that, here's a visual that I made that kind of summarizes my change. I now highly value getting great companies into my portfolio, and I undervalue getting those great companies in your portfolio at great valuations. Go back to my Salesforce example, that stock went up 60 times in value. 160 times earnings, it was a great buy. And if it was 300 times earnings, it would have been a great buy. And if it was 1,000 times earnings, it would have been a great buy. So the valuation you paid for Salesforce was far less important than getting Salesforce into your portfolio.
Wow.
Yeah. So that is a lesson that I have learned the hard way. So I know I just threw a lot at people again. Let me just pause. Are there any questions, Michael?
We do. We have a few. Let me just have a look. Let's see. We're talking about quality. Just remind the viewers, what are some of the metrics you use to assess quality?
Yep. So quality means different things to different people.
Yep.
In the book 100 Baggers, which I highly recommend people read if you're interested in this, he lays out the criteria that he used to assess quality. For me, it's the things that I laid out before as part of my checklist. The process for me was, what are the positive attributes minus what are the negative attributes? And that to me is what determines quality for me. And many of the quality criteria that investors use are very similar to each other. It's free cash flow, it's revenue growth, it's margin stability, it's what happens during a recession, it's returns on capital, things like that.
Okay. So I think that question ChatGPT could probably answer. Wouldn't give
It
you the
definitely help
metric.
with.
We have a couple on actually allocation and concentration. Single stock concentration. What are you comfortable with?
So what percentage of a company would I feel comfortable with putting in? So just like there's that valuation mindset spectrum, there's a concentration mindset spectrum. There are investors out there that own hundreds of stocks and have beaten the market. Peter Lynch has owned hundreds of stocks. His largest position when he was running Magellan Mutual Fund was 5% of his portfolio. 5%. And he walloped the market doing so. And then there's investors like Warren Buffett, who at one point, Apple was more than 60% of his investment portfolio, or Charlie Munger, that essentially had his net worth in Berkshire Hathaway and Costco and Watsco, another business. So he owned 3 stocks, and he considered to be diversified. To me, the answer to this question is just the sleep well at night test. What percentage in your portfolio could you devote to a single stock and you would be up at night worrying about it? For me, that number is 15%. If a company's more than 15% of my net worth, I don't sleep well. So that is the number that makes sense for me. But I know many investors that would be perfectly comfortable having 90% of their net worth in a single stock. And that's what works for them. So there's no boilerplate answer. There's only what is the right answer for you.
Okay, so on that point, if your stock is, accelerating and it exceeds the 15%, would you trim, rebalance? Is that when you're taking profits? Is that your signal?
I have done that in the past. I have trimmed companies, even companies that I thought had great futures ahead, were wonderful performers and all that kind of stuff, because the goal, let's rewind the clock. What is the goal of investing? The goal of investing is to live a better life. If investing keeps you up at night, your investing is making your life worse. So the goal of investing is not to maximize a number in a spreadsheet. It's to live a better life. So even if mathematically or academically having a higher concentration was quote unquote the right thing to do, I'm perfectly comfortable trading that academically right answer for an emotionally right one.
Okay, that makes sense. And just one last question before moving on. Any sectors or geographies that are interesting right now that you're looking at?
To me, my favorite sectors to look at are technology, healthcare, and services, because those tend to have a higher concentration of companies that meet the criteria that I'm looking for. As we speak, valuations in each of those sectors are very high. So I have not been a net buyer of stocks in 2025 or in 2024 because valuations have been high. I've actually been raising cash in my portfolio to account for that. But I've been investing for 20 years, so the biggest allocations that I have are to stocks that I bought 10 plus years ago,
Wow.
and they're up so much that they've become a bigger part of my portfolio. So if I was building a portfolio from scratch, you can bet that I would be looking in those sectors, because those are the sectors that I've identified as interesting to me and have the highest concentration of companies that meet the criteria that I'm looking for.
Okay. And are you just investing in the US?
Yes.
Okay.
I buy companies that are in U.S. markets, and the U.S. I'm completely spoiled because by market capitalization, the United States is like 70% of the market value of the entire world, and the U.S. has companies that are extremely well diversified and extremely geographically diversified. Like, yes, let's say you buy Apple, U.S. company. Okay, a majority of Apple's revenue comes outside the U.S. So,
Hmm.
is it a U.S. company? To me, a company is diversified based on where its customers are and where it's got its revenue, not where its headquarters is.
All right. Perfect. Thank you.
Yeah, great. All right, so I threw a lot at you. Thank you so much for paying attention. Let's just talk about some of the key takeaways that we discussed here. Key
Hmm.
takeaway number one: a minority of stocks, 7% of stocks, drive the majority of the market's return. Getting those winning stocks into your portfolio is everything. The losers you get in there don't matter, or the losers you sell don't matter. The only thing that matters is the winners that you get in there. Christopher Mayer's excellent book identified the categories that make for a winning stocks. They're small, they're quality, they're growth oriented, they're durable, and they're trading at good valuations.
Hmm.
My process is that I find stocks, I screen them for quality based on what I want, and I purchase my favorites. Make a list of the attributes you think are attractive, and make a list of the attributes you think are unattractive. The way that people think about valuation changes depending on where they sit on the valuation mindset spectrum. Over the short term, valuation is everything. Over the long term, sales and profit growth is everything. And it doesn't matter how many losers you buy. If you go through this process and 9 out of 10 stocks you buy are losers, that doesn't matter. The only thing that matters is, can you get those few big winners in your portfolio? They drive everything, with the sole caveat being, as long as you don't sell that mega winner early, which is the biggest mistake you could possibly make in investing, and one that I have personally made many times. Well, thank you
All
guys
right.
so much for your attention. My name is Brian Feraldi. You can connect with me on all the socials, and if you're interested in how to do the research on the stock, I do have a tool out there called Stock Simplifier. That is a tool and a course that walks through the entire stock research process. So if you're unfamiliar on how to do that, I do have that. And now let's
Brian,
go to Q&A.
perfect. We do have a question. Facing, do you try to time the market at all? If you think there's a recession or some market turmoil, you mentioned you are building up your cash position, but
Yep.
do you try to sell? Do you hedge? What do you do?
So I currently have about a 20% cash position. So
Hmm.
80% of my money is still in the market. I want the vast majority of my capital invested in the market at all times. Um, right now is a little bit of a different time for me because valuations are quite high, and we
Hmm.
have pretty high geopolitical uncertainty, and we have potential for inflation. But the biggest reason I have that much cash position is Warren Buffett's cash position is 60% of his portfolio. So I don't try and time the market. I try and invest at attractive valuations. The market being high it doesn't bother me. The market being high with high valuations does. So
Mhm.
as I've said, when Warren Buffett starts to invest his money heavily in the markets, so will I.
Interesting. Now, you've been investing for a while, and we're talking about selling the mega winners. What's your view on Bitcoin?
Bitcoin is something that I am fully aware of. I own a teeny tiny bit of, and I dismissed early on as uninvestable. Um, a big reason why I dismissed it as uninvestable is Bitcoin does not create cash flow. There's no
Mhm.
profits that come from cash flow. It's the same reason I don't invest in gold or
I
commodities.
was
They
just going to
don't
say
produce
that.
cash flow. If they don't produce cash flow, if they're not a productive asset, I don't know how to value them. And for
Yep.
me, it's not that you can't do well with Bitcoin. It's that is outside my circle of confidence. My circle of confidence is I understand businesses. I understand businesses that produce profit. I understand how to value them, and I can get the returns I need from businesses. So for me, Bitcoin is not a match for my investing personality, but I recognize that it is a match for other people's investing personality. And if you know more about it and want to allocate capital to it, just make sure you know what you're doing.
Yep. I think you mentioned it in one second. It's what you're comfortable investing in that's not going to cause you to lose sleep.
Right.
That's the name of the game, right? You have to be able to sleep at night. If you're investing in things or overly concentrated, that's not going to be an enjoyable journey, and that's not going to help. I think we're pretty much done. We have a few questions. We didn't get a chance to get to all of our questions. There are a few, but Brian, I really, really had a great time. Very insightful. Thank you so much for sharing your insights and your process with us.
Thank you for having me. I appreciate the invite, and I hope that this was I hope this was helpful.
I think so. Thank you, everyone, for joining us on our webinar. We will be sending out a link with the recording. And yes, if you have any more questions for us, you can always send it through to our team, and we will hopefully get those answers for you. Thank you so much, and have a great night.